Today I'm going to spend a lot of time talking about debt, the U.S. debt, and bonds and interest rates. I'll begin with a piece from Paul Tudor Jones. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 17th, 2023. As I said, I'm going to begin with a piece from Paul Tudor Jones. He is, you may, if you're in the investment world, you might know of him because he's a big hedge fund manager, very successful, manages a lot of money and has done very well. People recognize his name oftentimes in the industry. He has some good insights. This is on dealing with the debt. The debt, in my opinion and in his opinion, is going to crush us. It is going to collapse a lot. Maybe our currency, our economy, certainly the stock and bond markets. It has a lot of implications. When is that going to kick in? Well, I don't think today. Probably not this year, maybe not next year. But at some point, debt is climbing so high, so fast, and with rising interest rates, it's accelerating the amount that the debt is going up. So he talks about that. Now, the reason I thought this was interesting was because, first of all, he's credible. Secondly, he offers some solutions. The solutions he offers are not popular. You probably won't like them. Would you vote for a politician who took the stand that he is taking? I doubt it. It's painful. It's a bitter pill to swallow. It's not so horrible it would crush us, but his point is that if we don't do something and do it fairly soon, we are past the point of no return, and maybe we already are, but we have to do something. Politicians on both sides of the aisle, Republicans and Democrats, both of them are unwilling to tackle this issue, and both of them are running up debt at a ridiculous level. And with interest rates going up, this is compounding the problem. So I won't go into his solutions. I'll let you listen to him, but it's a really good piece. I've tried to put together the pieces of his interview that I think are the most significant, so I can keep it somewhat short, but it'll be a few minutes. But I think you'll like this. At least he approaches it from a common sense standpoint as somewhat of an outsider, not a politician, doesn't really have an axe to grind. He's obviously very wealthy, and some of his comments are very much not self-serving, as you will hear from what he has to say. So I'll begin here, and then so take a listen.
You just said, would you want to own equities? I mean, there's also the question of what you think is going on in the United States with our economy, with the rest of the world, with what the Federal Reserve is or isn't going to do.
It's a really challenging time to want to be an equity investor in U.S. stocks right now. It's really hard because, again, you've got the geopolitical uncertainty, which I think, come to live with to a certain extent. But again, all those have the ability to have a nonlinear outcome. So something not just business as usual. But I think equally as much of a problem is the fiscal situation that we're facing in the United States, which is going to require a completely different political mentality.
That's pretty telling. So we're, the possibility of a real possibility of a nuclear war is there, but our fiscal situation is just as bad. That's a statement. So black swans, Paul, they're not black swans anymore. They're actual quantifiable risks. We need a new word for black swans. There's like 4 or 5 of them that used to be, you didn't even have to really, if it happened, we're all gone anyway, so you don't worry about it. But now they're actually something that are on your radar. Well, so is a pandemic, which was on your radar in Davos before anyone knew the word.
I would say the fiscal situation is very different from other cataclysmic events that we've suffered as a country. It's not Pearl Harbor. It's not 9/11. It's not COVID, where we did not see them coming. They were external shocks. The fiscal situation we have is one that's really clear, and there are obvious remedies for it, and it's something that we're going to have to deal with. It's not part of the political dialogue yet. Really, I don't think so.
Entitlements again.
Well, it's a variety of things.
But
so
mostly.
If you just think about what's happened since really in the last 3 or 4 months, we're getting ready. I don't know if we'll have a Minsky moment in the bond market. I don't know if we'll have that point of recognition, but we're going to have the grinding reality that with 122% of debt to GDP, as interest costs go up in the United States, you get in this vicious circle where higher interest rates cause higher funding costs, cause higher debt issuance, which cause further bond liquidation, which cause higher rates, which put us in an untenable fiscal position. Our interest bill is going to very shortly exceed our defense spending in just a couple of years. It's probably in 4 or 5 years, ceteris paribus, we'll have the highest interest bill as a percentage of GDP that we've ever had. It'll probably be close to 20% of your taxes will go to pay interest on the debt unless we do something. We're going to have fiscal retrenchment. We're going to have to sacrifice. We're going to have to cut spending. We're going to have to deal with entitlements. We're going to have to change Social Security. We're going to have to limit Medicare and Medicaid. We're going to have to raise taxes on the very wealthy. We have, right now, here's what the bond market is telling you. Last year, or this year rather, we had $2.3 trillion of funding that the private sector is required to find the funding for. So that has caused a 100 basis point spike in bond yields. In 2024, it's going to be $2.7 trillion in the U.S., $2.7 trillion. Almost 10% of our budget is going to have to be to fund our federal spending.
So it doesn't matter what the Federal Reserve says at this point. They've lost control. This is going to be the bond market talking and setting.
Yeah, the bond market. So what's happening is, and why we're probably going to go into recession sometime in the first quarter of next year, probably because the bond market, simply through supply and demand, is going to deliver more rate hikes because we don't have a clearing price yet for long-term debt. And so those rate hikes are probably going to tip us into recession.
The other thing I forgot to mention on Paul Tudor Jones is that his estimation is that we are close to a recession. Probably he says the first quarter of 2024. These things are very hard to predict. And so when someone comes out with a date, no matter how credible they are, it's oftentimes very hard to hit. He may be correct, but I think a better way of framing this would be in our not too distant future, we have a recession coming. I think that would be a correct statement and, most likely to be correct. Next, I want to play a piece from CNBC. Tyler Matheson is interviewing Andy Constant. He's going to be talking about bonds and interest rates. Interest rates, inflation, and interest rates and bond yields continue to go up. What this means is that bond prices and bond fund prices, bond ETF prices, are going down. I showed you last week that the long-term government bond has declined since July of 2020 to now, which is about 3 years and 3 months, has declined about 50%. Maybe today it's now 49%, but it's 50% decline. The 10-year government bond, ETF, IEF is the symbol, has declined 27%. This is supposed to be the insurance policy, the protection against equities. So as equities have gone down, bonds have pushed them down even further. So the traditional 60-40 buy and hold portfolios are under a lot of pressure. They are negative or anemic at best. So all because, really mostly because of bonds being unable to support the decline in equities. So anyway, I think it's a good interview. He does talk about interest rates and bond prices, but think in terms of portfolios. That as he talks about interest rates going up, think conversely bond prices going down in this crushing traditional investment portfolios. So take a listen to Tyler Matheson and Andy Constant.
All right, let's move on to talk a little bit more about bonds. Our next guest says another big bond move is coming, and let's bring in Damped Spring Advisors CEO Andy Constant. Andy, welcome. Good to have you with us.
Thanks, Tyler.
What's that big move? Which way and why?
So, about last time I was on in August, we talked about the announcement of the issuance of long-term bonds, and that set the tone for the bond market for the last 2 months. Since then, we've also had strong economic data, and it's possible that that data may encourage the Fed to actually follow through with their hike. But with data out of the way, with the non-farm payrolls and CPI out of the way, the next big bond move isn't likely until the Halloween quarterly refunding announcement. And at that announcement, there is going to be a large deficit that needs to be financed. And Secretary Yellen holds the lever on whether she continues to issue the bonds that she did in August or shifts back to issuing bills. My sense is she will continue on the path of terming out the financing of the federal deficit debt, and that will mean large quantities of bonds. But regardless, we've had a 55 basis point increase in term premiums on bonds, and that's a big move. And so the next slug of bonds that the market has to absorb will likely not make quite as big an impact, more on the level of 10 to 20 basis points.
So okay, so if she's going to go and, as you say, choose to go issue bonds to finance the piling up of deficit money, and it's really shocking how much deficit money needs to be financed. That would suggest that interest rates on longer term securities are going to go up. By how much? Did I hear you say? How much?
Call it 25 basis points.
From where we are now on the 10-year, which is what, 4.65-ish?
Yeah, and I wouldn't be surprised to see 5.25, particularly if the economy does sustain this relatively high GDP. So some combination of the economy not yet ready to turn over and this large supply could drive us into the fives on the long term, on the 10-year note.
Next is a piece from Rick Santelli on CNBC. He talks about this interview came about from the consumer sentiment report, that Michigan Consumer Sentiment Report that came out last week. This follows a few minutes after that came out. And what was interesting was that the consumer sentiment, which is a good measure of what goes on with the consumer, was weaker than expected. And so his point is inflation is going up now at the CPI, not inflation, but the consumer price index is at 3.8%. So that has risen. It didn't continue to go down like they were hoping it would. So it's now back up. So inflation, consumer price index going back up, and interest rates going up, and consumer sentiment going down. So his point is basically he's going to throw a lot of data at you, but basically things are going in the wrong direction. And what this portends is a hard landing. They call it hard landing. In other words, it's going to some extent, crash the economy. I don't mean that it's just going to hit the brakes and everything goes upside down, but things are going to slow down quite a bit more if all of this continues in the same direction. And people are saying, like, Paul Tudor Jones said, they continue to say that this is going to end in a recession. And what that means also is somewhere in that time period, it means that stocks and bonds are probably going to be going down. Stocks for sure, and probably bonds. So Anyway, it's an interesting, this is a follow-on to the report moments after it came out. Take a listen to Rick Santelli.
Yes, good morning, Carl and Sarah. And do look at interest rates. They're moving up a bit. Stocks moving down a bit. Maybe here's the reason why. University of Michigan sentiment at 63, a disappointment. Weakest level since May. Now, these are preliminary. They can't change. 66.7 on current conditions. Much weaker than 70.3. Expectations, 60.7. We were expecting a number closer to 66. Also, the weakest number since May. And one-year inflation went from a 3.2, lowest since March of 21, to the highest since May of this year at 3.8%. And 5 to 10-year inflation moved from 2.8, the lowest since SEP of 22, up to 3%. And even though we've had several 3%, to find a higher number at 3.1, guess what month? You have to go to May. So May is wild, and these are wild numbers. Higher inflation, weaker confidence, and this could be the stencil to pay attention to as prices remain sticky and growth becomes more questionable, at least based on some of these qualitative surveys.
So I put the slide in here to illustrate that I continue to read, and I'm not going to give you any clips on it or any charts on it, but I continue to read a lot about food shortages, coming food shortages. And all I can say is that's what I read a lot. So I wanted to just put this out there and say, if you believe what I believe, that there are coming food shortages, and I'm going to give you the reasons why, the reasons that I've read and think about, then you have the opportunity to prepare yourself. Prepare yourself mentally that we're going to have food shortages. And what that means is, of course, prices are going to go up. But I don't mean just that. I mean that we are actually going to come to a point, I believe, this is my opinion, that we will go to the grocery store and there won't be any food. We'll go to another grocery store and there won't be any food. Or there will be some, but they're not the things we want to eat or the things we went to shop for. So this, I think, is not too far away, and I'm going to tell you the reasons why I think this. So this is a summation of the things I've been reading. So farmers a lot of farmers are losing their land to corporations and governments. The ones I saw mentioned were the Netherlands, Sri Lanka, South Africa, and the United States. Now, why would each of these governments and big corporations be taking over land and forcing out farmers? I don't know. That would be speculation. It's probably political, but I don't know that. There is foreign competition. Food that's coming in, vegetables and fruit, for example, and probably, beef and pork and chickens, coming in from China and from Mexico they can produce food and meat at much, much lower prices, and that's driving down prices, which is forcing farmers out or forcing them to sell. Extreme weather conditions, all the way from droughts to floods, not just here, but around the world. I've seen it in Europe, in Australia, and in the US. Inflation, cost of diesel and taxes and wages. Not enough workers. That comes down to wages. So farmers can only stand to pay so much because they've got whatever they pay, they're already on a thin margin. So whatever they pay, they're going to have to pass it on to the consumer or to the retailer who they sell their food to. So I know two farmers here in the Flathead Valley, and both of them say the number one issue they've got is not enough workers. They just can't find the workers. The problem with workers is that the cost of housing is so high here, they can't afford to live here on the wages they're being paid. So, this is just one little microcosm of a bigger picture. I don't know that is the reason in other areas, but I would say it's probably the number one reason here in our area. And then urban expansion. Over decades, maybe the last 4 or 5 decades, There has been an expansion of cities in industrial areas, residential, pushing out the urban areas into what has been farmland. And the statistics I saw was, I believe, about 50 over the past 50 years, that there has been about a 65% decrease in the amount of farmland, going from about 600 million acres, 650 million, down to about 200 million. And that is primarily due to the expansion from in urban areas. I can tell you, we live in a rural area. This is, I see in this area that happening here. As the people are moving in, more and more areas are being built out with homes and in light industrial and storage and so forth. And so it's happening here, and that's, where's it going? It's taking farmland. So the farmers are faced with a lot of issues, but I think it's going to come back to us, and it's going to result in the lack of food that we can buy. What can you do about it? You need to prepare yourself, I think, mentally for it. I'm preparing myself for it. And then prepare yourself functionally for it. Do you have enough food stored to last you for an extended period? That's hard to do because some food doesn't store long term, and some people don't have an adequate storage place, and it also costs money. So, but if you don't have that, think about having a relationship with a local farm or farmer where you can buy what you need and survive. So there are things you can do. I think if you just put it off, we saw what happened during the pandemic, where there was a run on food, and as you remember, toilet paper for some reason. And when that happens, if it starts to happen, there will be a run on the shelves, and we may not have a long period of time. So I'm just saying this FYI, and you can do with that what you want. Next, I read this morning, an article, and that's why I wanted to cover this, and I thought it was pertinent. It came from the website investing.com, which I subscribe to. And the article was this: the Fed will eventually break something, but what, when, and where? How are they going to break something? Well, they keep raising interest rates. That's going to break something. That brought me into the picture of debt. So I think the Fed, dealing with monetary policy, is going to continue to raise rates until something breaks. On the other side, on the fiscal side, on the government side, just as fast, the government is adding to debt as fast as possible. And as I said earlier, they're not willing to do anything about it. I saw this picture. I thought it was really a good, and this is on the debt side, not on the Fed side. But I thought this was interesting. This, just to give you a sense of the magnitude of our debt. Printed money, probably not much better. But there are 3 bars here. This is $100 bills. So the size of a chair, if you had $100 bills, that would add up to about $1 million. If you took the tallest building in the world, which is over a half a mile high, and stocked $100 bills, $1 billion would be higher than that building, a half a mile high. It would be 0.63 miles high. If you took $1 trillion, now this is not in scale, but if it were in scale, it would go off the computer. But the space station, the International Space Station, is 248 miles above Earth. If you stacked $100 bills high, 1 trillion would be 631 miles high. Now, I'll be honest with you, I can't fathom that. That is 2.5 times the height of the International Space Station. Now, multiply that times 33. That's the size of our debt. Stacked 631 miles high times 33. And it is going up fast. So what is it going to take to bring it down? I want to make one other comment on this debt issue that I didn't cover earlier, and that is, we could say, you may like your favorite politician. You're on the right or the left, whatever you are. And you may say, well, the other side, they're the problem. That typically is the way we think. But both sides of the aisle have contributed to this problem, I think, equally. When do you find a politician on either party, I can think of 2 or 3, but not many, that has said, I won't vote for it because it's going to raise our debt? And I have my problems, I have issues with both parties. But the problem with the debt is that it may not be them, it may be us. And the reason I say that is, are you willing to vote for a politician who, as Paul Tudor Jones said, is going to maybe reduce benefits in Medicare, reduce benefits in Social Security, reduce benefits in Medicaid? I'm just guessing, but I think there are about 200 million people who are covered under one of those 3 programs, one or more. So, and is also going to vote for somebody who's going to raise taxes, income taxes. Are you going to vote for that person? That's what he says the solution is. So we've got to deal with this, or I think we're going to collapse. What does collapse mean? Well, it could mean a lot of things. So I don't know exactly, but one of the scenarios I think that could happen is that our currency would become worthless. So you go to buy food or fuel or whatever, grocery store, you go to buy things and they don't take your currency. It's no good. Or it is so worthless that you couldn't haul enough of it into the grocery store. So that's what I mean by collapse. And of course, in that scenario, stocks are going to collapse and bonds are going to collapse. That is in our future, in my opinion, if, according to Paul Tudor Jones, we don't do something about it. What does that mean? I think it means politicians have got to work together. Good luck with that. When have you ever seen that? So, but they're unwilling to deal with this. I teach a class at the local college on Social Security, and so I do a lot of research on Social Security. So I learned that there is $2.8 trillion in the Social Security Trust Fund. There is a trust fund, and there are trustees who manage that, and they invest that money. And that money is not going to run out exactly, but by the year 2035, that's 12 years from now, Social Security will have to be reduced in benefits 20%. So current recipients of Social Security will get 20% less than whatever they're getting at that point. That would be very unpopular. Will politicians do something now when they could make the pain of that very little, very, very palatable? No, they're not. They're not going to do it. I think they're going to do it right at the last minute, the last year, maybe the last month. I don't know. It's ridiculous that this is fixable, and that if you get together and say we've all got to make some compromises, we'll put our ideas on the table and we'll fix this so that we can start bringing down the debt, so that we can our currency can survive, our economy and our way of life can survive. That's not a bad goal. But it takes politicians, in my opinion, being willing to work together to come up with a solution. Getting enough people from both sides of the aisle to work on that. But this shows the magnitude of the debt, and it is going higher, faster. Finally, most of us listen to news that supports our political point of view. Do you know anybody that listens to the other side regularly? I don't. Most people listen to this. This became obvious to me when I was in Seattle. I was called for jury duty, and it was interesting. It was a murder case, and they called 200 people. put them in a room, and they go through and ask a series of questions of each of the 200, and they want to narrow it to a group of 12 with a backup group of 12. So they basically select 24 out of 200. In interviewing, and it's a murder case, so in interviewing the jurors, potential jurors, they asked this one question. I never forgot. I thought it was so insightful. They asked the question, what is your news source? What is your primary news source? And, you know, it could be, you know, CNN, NBC, you know, Fox, you know, MSNBC, whatever. All of these sources, Bloomberg, whatever people said, Reuters, and the point of it was to try to determine what your bias was. What is your worldview? But where do you get your news? Why? Because they're all biased. It's all biased news. It doesn't matter where you get it. They all have a bias, and they present hard news, not editorial or opinion, but hard news often still in a biased way. So I was looking at one point of trying to find a news source that was more independent. I didn't want the bias. I just wanted to just get factual news. So recently, I don't know how I found this, but there is a news source that is unbiased. And that's the reason they exist, and it's called 1440. They have 2.8 million subscribers. It is free. They do not charge for it. How do they make their money? I don't know. I don't see ads, but maybe there's ads somewhere. And it is completely unbiased. And I've read it, and I've read it. I read it every day, and I look for, is there a bias? I can't find one. There is not a right or left. It's right down the, I guess you'd call it Walter Cronkite kind of news. It's right down the middle, and if it's there, I don't think it's there. So I'm just saying that in case you're interested, it's free. Put in 1440 in your search engine and you'll find it. And you can subscribe, you know, putting your email address, and every day you get this feed. And I just thought it was very interesting. Maybe if you're interested in unbiased news, this is a source for you if you don't already subscribe to it. Or maybe you just prefer to have news that supports your worldview. But okay, thank you for watching. If you have questions or comments, leave them in the comment section below. And if you like this, I appreciate it if you'd give me a thumbs up. And if you are not a subscriber, hit the subscribe button or the bell for notifications if you want to be notified of future videos. Thank you for watching.